The biggest tax mistake most retirees make is not dramatic. It does not involve exotic investments, offshore accounts, or complicated loopholes. It is something much quieter and far more common. They take money out of their accounts without a real plan for how those withdrawals will be taxed. They treat all their retirement money as if it is the same, and they let convenience decide which account to use. Over 10, 20, or 30 years, that single habit can cost a retiree tens of thousands or even hundreds of thousands of dollars in unnecessary taxes. The frustrating part is that most people who make this mistake believe they are being careful. They are simply doing what feels natural. While you are working, the tax system mostly runs on autopilot. Your employer withholds taxes from your paycheck, and at the end of the year you file a return. The decisions are limited. In retirement, the system changes completely. Suddenly you become the one who decides how much taxable income to create each year and which accounts that income will come from. The IRS does not care that you are trying to live modestly or that you are being responsible with your savings. It only cares about two things: the type of account the money came from and the total amount of taxable income you generated. That shift is where the biggest mistake begins. There are three main types of accounts, and they are taxed in completely different ways. Traditional 401ks and traditional IRAs gave you a tax deduction when you contributed. The money grew without being taxed each year. But when you take it out in retirement, every single dollar is taxed as ordinary income, the same way your salary was taxed. There is no special lower rate. Roth IRAs and Roth 401ks worked the opposite way. You already paid tax on the money before it went in. As long as you follow the rules, qualified withdrawals, including all the growth, are completely tax-free. Taxable brokerage accounts sit in the middle. You invest money that has already been taxed. You pay tax only on the growth, capital gains and dividends, and long-term capital gains are usually taxed at lower rates than ordinary income. You also have complete flexibility. You can take the money whenever you want without early withdrawal penalties. When someone reaches into these accounts without thinking about the differences, they often create unnecessary taxable income. That extra income can do more damage than most people realize. It can push them into a higher tax bracket, make a larger portion of their Social Security benefits taxable, and trigger higher Medicare premiums through IRMAA. One unplanned withdrawal can create three different tax problems at the same time. This is why the biggest mistake is not any single action. It is the absence of a deliberate withdrawal strategy. Without a plan, people tend to do what feels easiest. They spend the taxable account first because there are no penalties. Or they take large amounts from the traditional IRA because that is where most of their money sits. Both approaches can be expensive over time. Consider a very common situation. A couple retires at 65 with a large traditional IRA, a smaller Roth, and a taxable brokerage account. They need about $70,000 a year to live comfortably. Social Security will eventually provide $35,000. In the early years, they simply take the extra $35,000 from the traditional IRA because it is the biggest account and the most familiar. Each withdrawal is fully taxable. Their taxable income rises. A portion of their Social Security becomes taxable. They find themselves in a higher bracket than they expected. Over 10 or 15 years, the extra tax they pay compounds into a very large number. If they had instead used a mix of taxable account withdrawals and carefully timed Roth conversions in the early years, they could have kept their taxable income lower and reduced the size of future required minimum distributions. The difference in lifetime tax is often dramatic. Required minimum distributions make the problem worse. Once you reach the age at which RMDs begin, currently 73 for most people, the government forces you to take money out of traditional accounts whether you need it or not. The percentage starts relatively modest and increases every year as you get older. If you have spent the previous decade ignoring tax planning, your traditional balances may still be very large when RMDs start. Suddenly you have a large required withdrawal stacked on top of Social Security and any other income. The tax bill can jump sharply, and there is little you can do about it in that moment. The real planning window was the years before RMDs began. Most people only discover this after the window has closed. Another version of the same mistake is failing to use the gap years wisely. The gap years are the period between when you stop working and when RMDs begin. For many people, this is a stretch of 5 to 10 years. During this time, your taxable income is often lower than it will be later. These are the years when Roth conversions are frequently most powerful. You can move money from a traditional IRA to a Roth IRA, pay tax at a relatively low rate, and permanently remove that money from the future RMD calculation. Yet many retirees treat these years as a time to simply spend and relax. They take only what they need and leave the traditional accounts untouched. When RMDs arrive, the balances are still high and the tax problem is fully formed. Social Security taxation is tightly linked to this mistake. The more taxable income you create from traditional retirement accounts, the more likely you are to make your Social Security benefits taxable. Up to 85% of Social Security can be subject to federal income tax once your combined income crosses certain thresholds. People who withdraw heavily from traditional accounts often end up paying tax on money they thought was safe. The interaction between IRA withdrawals and Social Security is one of the most common sources of surprise tax bills in retirement. Medicare premiums add another layer. Higher income in retirement can trigger IRMAA, income-related monthly adjustment amounts, which raises the cost of Medicare Part B and Part D. The thresholds are not extremely high, and the look-back period means that income from 2 years earlier affects your premiums. A large traditional IRA withdrawal or a poorly timed Roth conversion can push someone over an IRMAA cliff and create higher premiums for an entire year. Once again, the root problem is the same: decisions made without considering the full tax picture. So what does avoiding this mistake actually look like in practice? It begins with a clear inventory. You need to know exactly how much you have in traditional accounts, Roth accounts, and taxable accounts. This is the map. Without it, every withdrawal decision is guesswork. Next, you need a realistic picture of your spending need and your guaranteed income sources, Social Security, pensions, and the like. The difference between what you spend and what those sources provide is the amount that must come from the portfolio. That gap is what you manage. Then you look at the calendar. How many years do you have before RMDs begin? Those years are valuable. They are the time when you can fill lower tax brackets with Roth conversions or with capital gains realizations from taxable accounts. The goal is not to create artificial income for its own sake. The goal is to use the lower tax years deliberately so that later forced income is smaller. A practical framework many good planners use is to decide each year how much room remains in the current tax bracket and then fill that room intentionally. Some of the room may be filled with ordinary income from a Roth conversion. Some may be filled with long-term capital gains. The rest of the spending need is met from the most tax-efficient source available. This kind of annual tax bracket management is the opposite of the biggest mistake. Instead of reacting to whatever feels convenient, you are shaping your taxable income on purpose. It is also important to revisit the plan regularly. Tax laws change. Your spending changes. Markets move. A strategy that made sense at 65 may need adjustment at 72. The biggest mistake is not only the absence of a plan at the beginning. It is also the failure to update the plan as conditions change. Some people hear all of this and feel overwhelmed. They worry that proper tax planning in retirement requires complex software or expensive advisors. While professional help can be valuable, the core ideas are not complicated. Know which accounts are taxable on withdrawal. Know when RMDs begin. Understand that extra taxable income can make Social Security taxable and raise Medicare premiums. Use the years before RMDs to reduce future required withdrawals if it makes sense for your situation. Take money from accounts in an order that keeps your tax rate as steady and as low as reasonably possible. The retirees who avoid the biggest tax mistake are not necessarily the ones with the most sophisticated investments. They are the ones who stopped treating their accounts as interchangeable and started treating their tax rate as something they could influence. They accepted that the tax system in retirement is different from the tax system while working, and they adjusted their behavior accordingly. There is one more subtle version of the mistake that deserves mention. Some people become so focused on avoiding tax that they underspend in retirement. They refuse to take money from traditional accounts even when they need it, or they delay enjoyable experiences because they fear the tax bill. This is the opposite extreme, and it can also reduce quality of life. The goal is not to pay zero tax. The goal is to avoid paying unnecessary tax. A well-designed plan allows you to spend with confidence while still keeping the long-term tax cost under control. If you are already retired and you recognize yourself in this description, the good news is that it is rarely too late to improve the situation. Even after RMDs have begun, you can still make better decisions about additional withdrawals, charitable giving through QCDS, and the use of taxable accounts. The earlier you start, the more options you have, but improvement is possible at almost any stage. If you are not yet retired, the lesson is even clearer. The account location decisions you make while working, and the planning you do in the years just before and just after retirement, largely determine how heavy the tax burden will feel later. Building some Roth savings, maintaining a taxable brokerage account, and understanding the coming RMD schedule are all ways to avoid painting yourself into a tax corner. The biggest tax mistake retirees make is not flashy. It does not involve illegal schemes or exotic products. It is the quiet, repeated decision to take money out without a tax plan. Over 20 or 30 years of retirement, that habit compounds into a very large cost. The alternative is not complicated. It is simply to treat taxes as a design problem rather than an unavoidable bill. Once you see the accounts as different tools with different tax consequences, and once you start choosing which tool to use each year with intention, the difference in outcome can be substantial. This is the foundation of every advanced strategy we will cover in the rest of this series. Roth conversions, withdrawal sequencing, Social Security taxation, RMDs, QCDS, and IRMAA planning all rest on the same basic insight: the tax you pay in retirement is heavily influenced by the order and timing of your withdrawals. Avoid the biggest mistake, and every other strategy becomes more powerful.